Welcome to this explainer. Have you ever actually stopped to wonder where money really comes from? It's easy to think the answer is just sitting right there in your pocket or on your banking app. But today, we're taking a magnifying glass to the mechanics of modern monetary creation, and we're going to completely shatter a common illusion about how your bank account actually works.
Section 1. The Great Banking Myth.
Okay, let's start with a universally relatable scenario. Imagine you walk in your local bank and deposit $1,000. The myth, right, the one most of us just intuitively believe, is that the bank simply guards your cash in some giant steel vault until somebody else comes along to borrow it. It makes total sense, but the reality is way more fascinating. Money today is digital and it's dynamic. Banks don't just sit on your cash. They actually have the ability to create brand new money, literally out of thin air, whenever they make a loan.
Section 2. Creating money from thin air.
I know, it sounds completely unbelievable, but let's zoom in to the micro level to see exactly how this digital illusion becomes an actual economic reality. Say you apply for a $10,000 business loan to buy a fancy new espresso machine for your cafe. When the bank approves that loan, they absolutely do not go down to a vault and scoop up stacks of someone else's physical cash to hand you. Nope. Instead, they simply credit your account with a brand new digital deposit. It's literally just keystrokes on a computer. And boom, just like that, $10,000 is born into the world fully available for you to spend.
Section 3. The Rules of the Game.
Now, the crucial point here is that the second you use that newly minted money to pay your supplier, it moves through the banking system and officially joins the circulating economy. Naturally, hearing this, you're probably asking yourself right now, wait, does this mean banks can just hit the zero key on their keyboards all day and create unlimited money whenever they want? Well, the answer is a very firm no. They definitely do not have a blank check. Banks operate within a highly regulated financial web overseen by government authorities. That power to create money is strictly conditional. Before extending any credit whatsoever, banks absolutely must actively manage financial risk, they have to maintain a strict safety buffer of their own capital, and they must meet incredibly rigorous regulatory requirements.
Section 4. The Balancing Act of Inflation.
So, while individual banks follow those strict rules, let's step back and look at the macro view. Central banks step in as the ultimate regulators of this whole system. Think of them like a giant thermostat controlling the temperature of the entire economy. And this brilliantly illustrates their absolute main tool, the interest rate. When central banks lower interest rates, borrowing becomes cheaper, people take out more loans, and money circulation goes way up. But when they raise those rates, borrowing suddenly becomes a lot more expensive, loan applications slow down, money creation cools off, and this intentionally hits the brakes on the economy to help reduce inflation.
And this balancing act is so vital. Why? Because if too much money gets created too quickly, demand rapidly outpaces the actual supply of goods and services. Basically, you get a whole lot more money chasing the exact same amount of stuff, and that leads directly to rising prices and inflation. Central banks are constantly monitoring this tightrope.
Section 5. Why economies need credit. Since keeping this money creation perfectly balanced is one of the toughest challenges for literally every economy, you might be wondering why we even tolerate this kind of risky system in the first place. Well, it's because credit is the true engine of the modern economy. Without lending, economic growth would just drastically stagnate. I mean, think about it. Businesses borrow so they can expand. Families need to borrow so they can actually afford to buy homes. And students leverage loans to pay for their education. Credit is what empowers all of that forward progress.
So, do banks create money out of thin air? Essentially, yes, but only within that very rigid framework we discussed. And really understanding those boundaries helps explain why those seemingly distant, abstract central bank policies and interest rates aren't just Wall Street jargon. They have a massive, immediate, and direct effect on our daily lives, dictating everything from the cost of your groceries to the mortgage rate on your house.
To wrap up this explainer, I want to leave you with a rather provocative thought. Our modern financial system isn't backed by physical gold locked away in some impenetrable vault. It is completely built on digital ledgers and regulated money creation, meaning that, yes, while money absolutely powers the economy, it is ultimately our shared trust, our collective belief in the banks, the regulators, and the system itself that actually powers the money. So what really happens to all that money if that trust ever wavers? Thanks so much for joining me today, and keep exploring how the world around you really works.